When it comes to Bitcoin and cryptocurrencies, taxes aren't the first thing that most investors think about. However, as the IRS continues to press down on crypto tax compliance, understanding how cryptocurrencies are taxed is becoming increasingly critical. Hey everyone, welcome back to our channel. In this video, go over all you need to know about cryptocurrency taxes. This information is based on US laws. Various countries or continents have different laws. If you want to understand more about a specific nation, please subscribe to our channel because we will be sharing more information on taxation in other countries as well. If you do have a certain country in mind, please let us know in the comments section so that we know then we'll assist you. And before we start, make sure to hit the like on this video if you like this kind of information. That would mean so much to us. Remember to subscribe and turn on the notification bell so you won't miss any of the upcoming videos. Done? Let's get started. Cryptocurrencies like Bitcoin and Ethereum are subject to capital gains tax rules, for better or worse. When you sell cryptocurrencies for a profit, the Internal Revenue Service considers it a capital asset, and you must pay taxes on it. When you sell traditional investments like stocks or mutual funds at a profit, this is exactly what happens. The amount of capital gains taxes you owe is determined by whether you've owned your cryptocurrency for less than a year or more than a year. If you haven't yet hit the 12-month mark, your profits will be taxed at the short-term capital gains rate, which is the same as your ordinary income tax rate. If you owned your coins for at least a year, you may be eligible for a long-term capital gains rate that is lower than most income taxes, depending on your taxable income. And just like any other investment that you sell at a loss, if your crypto investment loses value when you sell it, you can claim a capital loss that you can use to offset other income taxes. However, there are a couple of snags with cryptocurrency taxation. When you buy something using cryptocurrency, it counts as a sale of that coin. If the value of your coins has climbed over what you pay for them, you will owe capital gains taxes. You'll also be responsible for any applicable sales tax. It counts as part of your ordinary taxable income if you earn Bitcoin by mining it or if you receive it as a promotion or payment for goods or services. At your ordinary income tax rate, you owe tax on the entire fair market value of the crypto on the day you got it. And depending on how long you've held the cryptocurrency you mined or earned through these activities, if its value rises and you spend it or sell it later at profit, you'll face capital gains taxes on the earnings. It's never too early to get your crypto taxes in order. The regular Form 1040 tax return now includes a question about whether you used virtual money during the year. If you answered yes, you have to consider a few points in mind. 1. Maintain detailed records of all transactions. Keep track of all your cryptocurrency transactions, including how much you bought for it, how long you had it, and how much you sold it for, as well as receipts for each one. If you transfer coins between offline cold wallets and your account, your crypto exchange may issue a 1099-B to both the IRS and you, but it may not record the cost basis or the original amount you bought for your crypto. Software businesses have emerged that will scour the blockchain to discover transfers between your wallets, whether on an exchange or not, and give you reports of all transactions connected to the wallets you give it within a particular tax year. According to John Feldhammer, tax partner at Baker Botts, tools like Coinly and CoinTracker connect to exchanges and crypto wallets to help you keep track of your cryptocurrency transactions and fill out the papers you'll need to file your cryptocurrency taxes. Number 2. Complete the required tax forms. You'll need to fill out specific tax forms based on how you spent your crypto after you have a record of your transactions. Form 8949. This form keeps track of every time you buy or sell cryptocurrency as an investment. This should include the total quantity of coins, the date and price at which you purchased them, the date and price at which you sold them, and the profit or loss on each transaction. Scheduling D, this form, calculates your overall capital gains and losses from all of your investments, including cryptocurrency. Appendix C, if you obtained coins as a result of mining, you must state whether you received them for a company or a pastime. If your income for the year surpassed your expenses, you may owe self-employment taxes if you run a crypto mining firm. First schedule. If you declare crypto mining as a hobby, you'll report it on Schedule 1's Line 8. You won't have to pay self-employment tax, but your cost deductions will be limited. Number 3. Submit your tax returns. If you use Coinly or CoinTracker to keep track of your finances, you can link them to your online tax software of choice. Then, to file your overall state and federal tax returns, use the online tax software. Token Tax offers a full range of accounting services to track and prepare both your crypto and normal taxes for individuals searching for a one-stop shop. Number 4. Employ a profession. Getting ready for Bitcoin taxes can be difficult, especially when the regulations governing them are always changing. If you've made a significant amount of money through crypto, you should hire a certified public accountant that specializes in this type of tax work so the IRS doesn't come after you later. Do you fear you'll owe Bitcoin taxes in the future? Well, there are 6 things you can do to reduce the amount you owe. Number 1. Invest in cryptocurrency for the long run. Your gains qualify for the advantageous long-term capital gains rate if you hold a crypto investment for at least 1 year before selling. This can practically reduce your tax rate, ranging from a maximum rate of 37% for short-term gains to a maximum rate of just 20% for long-term gains, depending on your taxable income for the year. Number 2. Balance gains and losses. You can take advantage of crypto gains by declaring losses on other investments the same year you realize your profit, just like any other investment. That implies you wouldn't owe any tax if you gained $10,000 selling Bitcoin but lost $10,000 selling Ethereum because you broke even. However, these losses are not limited to other types of cryptocurrencies. Look over the rest of your portfolio to see if there are any other losing assets you may sell to balance your gains if you're about to cash in substantial crypto investment. In addition, if you lose significantly more money in a year than you make, you can deduct up to $3,000 in excess losses from your personal income taxes and carry over any unused losses to offset future investment profits. Number 3. Coordinate your sales with your tax rate. You can always try to wait out a lower tax rate if you have the luxury of time, according to Jeff Hoops, an associate professor at the University of North Carolina and research director of the UNC Tax Center. Perhaps you were laid off, retired, returned to school, or relocated to a place with cheaper taxes. You might then find yourself in a lower tax bracket, allowing you to sell your cryptocurrency while owing less in taxes, he says. Number 4. Submit a mining expenses claim. While mining cryptocurrency may appear to be a low-cost pastime in theory, it comes with a slew of costs, including computers, servers, electricity, and internet service provider fees. If you're a crypto miner, you can deduct these expenses from your earnings, albeit the amount you can deduct will depend on whether your operation is classified as a company or a hobby. Number 5. Think about putting money into a retirement plan. You can defer or avoid investment gains entirely if you invest in crypto through a retirement plan like a traditional IRA or Roth IRA. However, it's not as simple as investing through a regular brokerage account. There are ways to get crypto into tax-advantaged vehicles like an individual retirement plan. Says Hoops, but it is not common or easy. If you want to start a crypto or Bitcoin IRA right now, you'll need to open a self-directed IRA with a boutique firm that specializes in crypto investing. Number 6. Make a charitable contribution. If you don't need all of the profit from your crypto investment, donating at least some of it to charity can help you save money on taxes. Sam Bankman-Fried, the founder of FTX, has signed the Giving Pledge, a public promise made by the world's wealthiest individuals and families to give away the majority of their money to philanthropy during their lifetimes or in their wills. You'll get a tax break equal to the whole amount of your cryptocurrency, including any gains. However, this only makes sense if you were planning on donating to charity anyhow. But we want to let you know that it's not professional financial advice, but purely based on our own research and opinion. Did you find this video informative or helpful? Let us know in the comment section below. Make sure to subscribe so you don't miss out on my future videos. Don't forget to like and share.